Welcome to Cat Eye U.S. stock. We watch markets with calm focus and sharp instincts. It's Friday, January 23rd, 2026. On the surface, it looked calm. The S&P proxy, SPY, basically flat, QQ, slightly green. But the Dow, through DIA, and small caps, VIWM, both finished in the red. So this wasn't broad strength, it was narrow leadership. A handful of mega-cap AI and platform names holding the tape together, while more cyclical, rate-sensitive areas quietly rolled over. And underneath those calm index headlines, gold and silver were screaming that investors are still paying up for protection. Look at the S&P 500 Heatmap, and the story snaps into focus. You saw more green than red at the index level, but your eye went straight to those oversized bright green blocks in mega-cap tech and communication services. Microsoft, Nvidia, AMD, Meta, Amazon, Netflix, all lit up. Alphabet, by contrast, just a little red, and Apple mostly sat it out. Meanwhile, banks, a lot of healthcare, and big chunks of industrials skewed red. JP Morgan, Goldman, Eli Lilly, Caterpillar, notable drags. So the board said up, but participation said narrow. And as the day went on, leadership kept concentrating into a shrinking group of giants. That heat map lines up directly with the day's rotation. Capital kept sliding toward large cap growth. AI semis, cloud, big software, platform consumer names, and away from the classic cyclicals and rate sensitives. Nvidia and AMD drew buyers even as Intel imploded. Microsoft soaked up flows as the durable AI and cloud proxy. Meta and Netflix powered communication services, while Amazon and a few retailers kept consumer afloat. On the other side, money leaked out of banks and card networks, out of industrial bellwethers like Caterpillar, and out of high-flyer healthcare such as Eli Lilly. Small caps, via the Russell 2000 and IWM, lagged badly, underlining a strong quality and mega-cap bias. And in the background, a sharp bid into gold and firm silver showed investors quietly paying for hedges, while they crowd into AI. Put it all together, and the tension gets hard to ignore. Intel's brutal earnings miss turned into a sector-wide headwind, dragging on the Dow and reminding traders that not every AI story gets a free pass. Macro data didn't deliver a clean all-clear either. S&P global PMIs pointed to ongoing expansion, but tariff-linked price pressures stayed elevated. The University of Michigan read improved, and inflation expectations cooled a bit. Good for duration, sure. But not enough to override positioning into next week's big tech reports and the Fed. The loudest signal came from cross-asset hedging. Gold pushed toward 5,000, silver punched above 100 an ounce. That's a violent bid for safety alongside supposedly calm equity indexes. So Friday's tape wasn't some carefree melt-up. It was index-level resilience, manufactured by a handful of mega-caps, while breadth, cyclicality, and small-cap risk tolerance quietly deteriorated into the close. Around the desks, the chatter backed up that split personality. Options traders pointed to heavy short-dated call buying in mega-cap AI and cloud, Microsoft, Nvidia, Meta, Amazon. That flow looked like a mix of hedging and speculative upside, not clean, high-conviction buying. At the same time, desks flagged record-high gold and ongoing inflows into silver ETFs as stealth stress barometers. The talk framed it as classic tail risk insurance, geopolitical policy, macro, layered on top of concentrated AI bets. In other words, today's tech strength looked like a hedged risk-on trade, not a full-throttle melt-up. Chinese regulators are quietly cracking the door back open for Nvidia. Officials have told major tech firms, including Alibaba, Tencent, and ByteDance, that they can start preparing orders for Nvidia's H200 AI chips. This isn't full approval yet, but it's the most constructive signal investors have seen in months. Let's start the single stock lens with the problem child. Intel. Intel cratered after weaker than expected guidance, talk of a first quarter loss, and supply constraints. The stock dropped hard, turning one earnings print into a sector-level headwind. That move hit the Dow directly and hung over parts of the semiconductor complex, even as other AI-linked chips held up. More importantly, it sharpened the split inside the AI trade. This market is clearly separating perceived winners from the AI have-nots. And for now, Intel sits squarely in that second bucket until it proves otherwise. On the other side of that chip divide sits Nvidia. The stock traded higher, even with Intel blowing up the tape. Investors kept rotating back into AI semis and buying what they see as the clear leader. And in the background, those Chinese regulatory signals around H200 class chips effectively put a giant question mark, in a good way, back over a massive end market. Nvidia remains the poster child for AI hardware. Its ability to climb on a day when Intel cratered underscored just how selective this market has become about where it wants AI exposure. Microsoft was the quiet anchor of the whole session. Shares pushed higher, helped by upbeat analyst commentary around AI and cloud momentum. In a tape defined by narrow leadership, that really matters. As one of the biggest weights in both the S&P and the Nasdaq, Microsoft's strength helped keep SPY and QQQ stable, even as financials, industrials, and small caps rolled over. For investors looking for durable AI and software exposure, this is still a default parking spot, and a key reason the headline indexes looked calmer than the internals felt. Meta added real juice to the growth side of the ledger. The stock jumped on bullish sell-side notes and renewed optimism around AI-driven ad tools and monetization of threads, with analysts lifting price targets into earnings. That surge made Meta one of the brightest tiles in communication services and a high beta engine behind Nasdaq's strength. It also highlighted the market's willingness to pay up for scaled, profitable platforms where AI has a clear path to monetization, even as other parts of tech, like Alphabet, looked more tired. Amazon quietly did a lot of heavy lifting, too. Shares moved higher on continued enthusiasm for its cloud, advertising, and retail ecosystem, backed by bullish fundamental write-ups pointing to durable growth. Because Amazon straddles consumer discretionary and tech-adjacent exposure, its strength fed both the growth trade and the consumer story. In a session where investors clearly favored large, liquid quality over broad beta, Amazon fit the playbook perfectly. Not all leadership showed up on the upside. Eli Lilly is a good example. The stock fell as traders took profits in a very crowded GLP-1 and obesity drug winner. There wasn't some ugly new headline, just visible rotation away from high-flying healthcare. Given Lilly's size and prior run, that weakness dragged on the sector and chipped away at the S&P. It's another sign that in this tape, investors are trimming crowded defensives and funneling risk toward a narrower set of AI and platform stories. Caterpillar told the story on the cyclical side. The stock slipped on steady selling pressure, with data pointing to worries that industrials could be vulnerable to tariff noise and growth uncertainty. As a global industrial barometer, Caterpillar's slide weighed on industrials and contributed to the Dow's underperformance. It lined up cleanly with the rest of the tape. Investors leaning away from economically sensitive names while they fortify in mega-cap growth and hedges. And finally, you can't ignore the metals. Gold drove toward that 5,000 mark, and silver surged above 100 an ounce. That's not a casual move. That's investors actively paying up for geopolitical and policy tail risk insurance. Those flows matched reports of ongoing inflows into silver ETFs and strong demand for gold, even as equity indexes stayed composed. So while a tight group of AI megacaps held the tape together, the metals market was broadcasting something very different. This is still a hedged, uneasy risk on, not a market that's fully exhaling. So where does that leave the next open? The calendar gets heavy, fast. Durable goods, consumer confidence, and regional manufacturing early in the week. Then the Fed's rate decision, statement, and press conference right in the middle. On top of that, big-ticket earnings from Apple and other tech names hit just as markets are already leaning hard into AI leaders and away from small caps and cyclicals. Here's the setup. Positioning remains skewed toward mega-cap AI and platform winners, while gold, silver, and bank underweights act as the brake. How those hedges behave through Fed Week will tell you whether Friday's narrow resilience was sustainable positioning or just a carefully managed pause before volatility comes back. To wrap it up, Friday was not the all-clear those index charts might suggest. SPY and QQQ held up because a handful of mega-cap AI and platform names did their job. But DIA, IWM, banks, cyclicals, and crowded healthcare winners told a weaker, more cautious story. At the same time, gold and silver screamed that investors are still willing to pay up for tail risk insurance. Heading into Fed Week and marquee tech earnings, this market is still trading with one foot on the brake. The next few sessions will show whether narrow leadership is enough or whether the foundation under those calm headlines finally gets tested. Thank you for watching Cat Eye U.S. stock. Stay curious, stay calm, and we'll see you next time.